We start with the U.S. Central Bank. They are sounding more optimistic. The Federal Reserve believes economic growth will pick up in the second half of this year, but it thinks it's too early to end its bond buying program. This program is meant to encourage growth and lending. The Fed, as expected, kept rates unchanged near zero. In a statement released at the end of their two-day meeting, it said that with appropriate policy accommodation, economic growth will pick up and unemployment will decline. Economists and traders were looking for hints on how much longer the stimulus program would go on. The Fed did not offer a timetable. Committee members said the $85 billion a month bond buying program will continue until the labor market has improved substantially. The U.S. unemployment rate currently stands at 7.6%, and economists are not expecting that figure to change anytime soon when the July jobs report comes out this Friday. Now, global markets are also watching U.S. President Barack Obama and who he will choose as the next Fed chairman. The White House says they won't announce his pick until fall, but the president is already defending one of his potential nominees. Jessica Stone has more.
Current Vice Chair of the Federal Reserve Janet Yellen and former U.S. Treasury Secretary Lawrence Summers are both frontrunners to replace current Chairman Ben Bernanke, whose term is up in January. Yellen served as an economic advisor to President Bill Clinton and former chief executive officer of the regional Federal Reserve Bank based in San Francisco. She's been vice chair of the Fed since 2010 and supports the central bank policy of low interest rates and the $85 billion a month bond buying program to boost the economy and create more jobs. Bankrate.com's Mark Hamrick says Yellen has long been the frontrunner.
She is seen as a strong consensus builder. And to be a chairman of the Federal Reserve, you really need to be able to line up support for policy changes, and ultimately you need to have that support in the financial markets as well.
Lawrence Summers served as President Clinton's Treasury Secretary. Summers pushed for deregulation of U.S. financial markets. His critics argue that this created conditions that stoked the recent financial crisis. Summers is a critic of current central bank policy, but a close confidant of Obama's.
It seems as if this is all about who the president has the best relationship, and right now the name at the top of that list is Larry Summers.
Summers could have a tough time gaining U.S. Senate confirmation. Last week, nearly a third of U.S. senators wrote a letter to the White House urging President Barack Obama to nominate Janet Yellen to lead the U.S. Central Bank. On Capitol Hill Wednesday, U.S. President Barack Obama was forced to defend Summers in private meetings with fellow Democrats.
The president, of course, as I would and others would, defended Larry's tenure here at the White House and his service to the country and to the president in extraordinarily trying financial and economic times.
Last week, Obama told the New York Times, quote, "I want a Fed chairman that can step back and look at that objectively and say, let's make sure that we're growing the economy, but let's also keep an eye on inflation."
Something good and positive.
Despite the politics of the president's choice to lead the Fed, it may well be the markets that give the White House the most important stamp of approval, and Hamrick points out that the markets have yet to react to Summers as a possible pick.
All right, that was Jessica Stone. We now are joined by William Mahnic, Associate Professor, Banking and Finance at Case Western University, live from Cleveland, Ohio. Welcome to CCTV America, sir. I guess there's two big questions out there. One, what does the Fed mean by what they said today, and also who will be the next chairman? Let's start with the Fed action did today and the statement. No huge surprises, at least from the market and from the market reaction. When you read the Fed statement, did anything stand out to you?
No, I think, Phil, what the Fed has told us is they're going to remain constant in their stance that they're going to supply the quantitative easing until economic conditions improve, and they expect them to improve later this year. And then the other thing they're going to do is continue to make a monetary policy that's very accommodative by keeping short-term interest rates between 0 and 1/4%.
One of the prerequisites for them to remove this sort of quantitative easing is that the unemployment rate has to reach a certain percentage. And I believe that number is somewhere between 7 and 7.5. But in doing the math, the unemployment rate would literally have to be under 7% basically now for the rest of the year in order for the Fed to meet that objective. If that's one of the prerequisites, basically, isn't the Fed saying that they're not going to change the policy at least till the beginning of next year?
Well, that's a good point, Phil. What the Fed is talking about is tapering, not tightening. The Fed said they'll continue the QE policy as long as the unemployment rate remains above 6.5%. We're at about 7.5% right now. They're buying $85 billion worth of bonds on a monthly basis. What they'll start to do is they won't go from 85 to 0. They won't slam on the brakes. They're going to slowly take their foot off the accelerator and start to apply the brakes.
Are you happy with that?
I think that's the right way to go. I think they'll probably start in September. And the question is, well, how much are they going to pull their foot off the gas pedal? Are they going to go from 85 to 80, or are they going to go from 85 to 75? That's yet to be seen.
Are people like me and the rest of the global markets and people talking about this, are we overreacting to this pullback of this bond buying program?
In the short term, yes. You know, it's been a nice party. You look at the rally in the bond market over the last 3 years, and you've made returns investing in bonds that you normally can only make if you invest in stocks. That's going to stop. In fact, I would expect that total returns on long-term bonds will be negative for the next 12 months to 18 months.
That's a good point in itself, because the unintended consequences of having rates at 0 is that it pushes a lot of people to take risks when perhaps they should not take risks. I mean, if you force everyone to go and gamble their money, you're going to create some bubbles out there, dare I say it. Do you think that's something the Fed's also thinking about as well?
Absolutely. Remember, every month that the Fed continues this quantitative easing, they make it that much tougher to reverse it. They've been fortunate. Inflation has been very, very low, very, very tame. If you would have told someone that the Federal Reserve is going to triple the size of their balance sheet, increase the money supply by $3 trillion, and inflation would remain at 1.5%, they wouldn't believe you. But that's been a fact.
Well,
that
what
will change.
What we should have done is you, me, and the floor director and everybody else in the studio should have just borrowed as much money as we can at 0% and invested it overseas. And that brings me to my next question is, how is this going to impact the emerging markets who saw a lot of that money flow to their country when rates initially went to 0? But if rates were to change in the future, that's a problem, isn't it?
Absolutely. If we can get risk-free rates of return or AAA rates of return to the normal level, where they trade at about 1 to 2% above the rate of inflation in the United States, people will find that to be an attractive investment again. Consequently, the attractiveness of emerging markets should be diminished slightly.
All right, today President Obama gave us a bit of a surprise, talking about the Fed and talking about somebody that you know, I'm sure, is Don Cohn, as a potential nominee to replace Chairman Ben Bernanke. What do we know about him so far, and how significant is this?
You know, he's very dependable, very well known in the Washington set, very well known in Congress. He'd be a good consensus builder. He'd be a safe pick. I believe, though, that you're either going to see Larry Summers or Janet Yellen eventually get the position. Yellen has the experience. President Obama's had experience with her. Larry Summers is very, very close with the Obama administration and has a very good track record.
So we've got 3 names out there so far. We've got Yellen, we've got Summers, we've got Cohn. Cohn is an old hand at the Federal Reserve. He's been there for a while. He's worked his way. He knows everybody there. Summers is very interesting because his name comes up very, very often, but somehow it's controversial. And I don't understand why it's so controversial. Maybe you can help me with that.
Well, Bernanke changed the way the FOMC, the Federal Open Market Committee, works. Under Greenspan, it was more dictatorial. Greenspan would come in, set the agenda, and look for everybody to nod. Bernanke has changed that. He looks for votes, and he welcomes dissension. I mean, I think, and again, I'd have to check my facts, but I believe there's been more dissenting votes cast in Bernanke's term than there has been in all of Greenspan's term. Yellen would probably continue that. She would empower her fellow Board of Governors.
Are you saying that Yellen is what the market wants? Am I hearing that correctly? Is that what's best for the stock market and the economy?
Boy, that's a tough call. I would think, if you had to ask me right now if he named an appointment tomorrow, I think the market would be less concerned over Yellen than they would over Summers.
Okay. Willie Mahnic, excellent conversation, Associate Professor of Finance and Banking, Case Western University, joining us live from Cleveland. Thank you very much, sir. Have a great evening.